You're, y'all know I'm ghetto. No, I'm kidding. Not ghetto. Just coaching. What's up, y'all? What's up? What's up? All the way from the earth. And it's not flat, by the way. What's up, guys? What's up? What's up? What's up? Definitely, appreciate all of you guys, coming out, supporting everything that you guys have given over, since I began this. And I figured it was kind of overdue for a beginner's course. We were trying to put something together. There was some obstacles we obviously had, but I just felt like, spontaneously this is the time to do it, the time to let me make sure the Zoom meeting doesn't like automatically cut off because I set a meeting time. I wonder if it comes up to me. Let me see. I'm hoping it just doesn't like shut out, but if it does, you guys can go over to YouTube. And there's 94 people in the Zoom right now, so when you guys come into the chat, you can get into the Zoom that way, and we'll see some of the stuff that you write a lot faster. I hope I'm not too close to the mic. Let me just double check again on YouTube. And guys, also the Zoom, if the music is too loud on Zoom, you can go on YouTube. The music is perfect on YouTube. So yeah. But what's up? Good morning, guys. Good morning. My name is Dave, and this is segment is brought to you by Dave Teaches. I wanted to teach a little bit about the beginning of the movement in the market, So for anybody that doesn't understand, what we're currently looking at right now is a chart. This is a chart that shows the what word could I give it? And if you guys are watching this in reverse, like in reverse and in playback, you can just speed it up by like 1.5 times, because you guys know I talk really slow, because I want to say the right thing. So I actually think about the things I say before I say it, so yeah, rare quality, right? You could speed this up if you can, but this chart essentially shows the overall number or the health of a particular economy, a stock that's a company in the market, in the stock market, you buy and you buy a stock from, and you sell whenever it is that, hopefully you're not in drawdown, you sell it, but you're buying into the company, a stake, a position in that company. This chart here shows you whether your profit is going up, or whether you're losing value in that particular instrument. So obviously with investing, what most people know is that up is good and down is bad, and that's the way the market moves. It moves in patterns of price going up and price going down. What I mean by price is everything that you're looking at. Everything. If you want to see Bed Bath & Beyond, we have data that we could look at with Bed Bath & Beyond's stock. Look, I had it coming down here. So yeah, we have data that we could look at that lets us know how whoever it is that it's invested in a Bed Bath & Beyond, if you have a share or if you have a call option or whatever it is, this lets you know that up is good, right? And I'm doing this, guys, because there are other people who do not really understand anything about charts. So you guys are zero to hero. That's what I say, right? So up is good. And a market that goes up, we always hear that it has to come down, right? We just don't know when, or do we? That's for more advanced, charting, obviously. But this stock has a huge push up from $4 to $30 and back down to $3, all within the time span of 107 days. So you don't want to be the person buying here at the top before price is going to go down. So what if I told you that there are ways to track whether price is going up or down, or whether it will go up or down? That's exactly what this chart is for. The thing is, with the futures and the Forex industry, you could make money, and options as well. I won't say much about that, but you could make money with price going up, as well as you could make money with price going down. But if you're buying a stock, if you're buying it, wherever you buy it, your position is either going to increase, or if you bought it here, your position is going to decrease. It depends on the timing of when you buy it. So that's what a chart is, and how to use a chart in terms of when you're investing versus when you're trading. With futures, as I said, you can make money with price going up as well as price going down. You just have to know how to be a part of that, how to time that, how to understand that. And once you can understand that, once you have an idea of how to track that in real time, you can either be a person who places a trade once a week, a couple of times a week, a couple of times every other day, or a couple of times every day, or a ton of times every single day, 24/7, depending on what instrument you choose to trade. So the thing with investing is that you have to wait for price to go up. The thing with trading is that you don't need to wait for price to go up or down. You just have to be correct. You just have to be correct. So, obviously there are questions, what do you mean correct? Like, how can you be correct with knowing how to do this? That's where understanding how to read what this data that's being printed, when you learn how to read that, that's how you learn when and where you could be correct, when and where you could engage yourself in the market. And there are areas that are similar to some. Like here, you see this downtrending, rocking down, up, down, And then you see, after some time, a huge push up, right? You saw the same thing here. Rocking. Yep. Up, down, down. And then a huge push up like that. So you want to be able to time whether you could get in here for a buy or a long, or whether you should get in here for a short heading down. So there are particular things that this kind of movement does in real time that you can track. You can track the exact location of the movement and when it will react and where it can react. You have the ability to learn that, to know that, to see that. You have the ability to be able to see that and take advantage of either side of the market, whether it's going down or whether it's going up. Whether it's going down or whether it's going up. Guys, there's 82 people in the Zoom if you wanted to come over to the Zoom. Like I said, I just think the music might be loud for some people on the Zoom. Let me actually bring this down and say that to them. Because, some people like the music and then some people just rather hear. So there's people that guys, whoever's in the Zoom, the audio is quieter on YouTube. So use the YouTube video to listen in on. Yeah, you're gonna be a little bit delayed, but the audio is a little quieter. Actually, let me see if I could bring that up, and maybe right there. I can leave that there. It's just YouTube. You guys won't hear the music much, but I don't really think you guys care about the music, maybe. So that's fine. So yeah, this is what the market looks like. This is between December 2020 and July 2021. So as an investor in this market, between 2020 and 2021, some people like to put their money in stocks and let it go. And it's like, we'll see the health of it. We'll see where it goes. Some people buy here because they're like, oh my gosh, did you hear the news on that? That was, wow, it really pushed. And economists are saying that it's a great time to get in because, they're getting ready to go with this deal with Amazon and they're reforming the structure of their company at this level. That's when people who don't read charts, people who don't understand charts, that's when they hear about it. That's when they hear about it. So if that's when they hear about it, when they are slated to buy right here, because they're buying shares, they don't understand anything about stocks and buying in a position. Yes, you could short a stock too if you have the shares for it, but either way, this is when people who do not understand how to read a chart, this is when they hear about it. So they hear about it here and they load the boat up. Yep, I put some in because in my 401k, I'm gonna make sure it grows and the substantial growth of the like all the decisions that they make in regards to why it's a good time to buy. And then days go by. A whole month has gone by. And they're down 50%. That's what it say right here. You don't see that? You don't see that? Right there? A whole month goes by. And that position that they got in on FOMO, A month later, they're looking at the Robinhood, Webull, whatever app they buying on, and your value is down there because you bought when you heard that it was a good time to buy, right? But you didn't know how to read these charts, and you don't understand the behavior of these charts. You don't understand the behavior of it. So that's not only people in stocks. That's people in Forex, that's people in futures, that's people in crypto, that's people in everything. Everything, commodity trading, whatever it is, that's people in all different types of trading. It's just some of those people have the patience to hold a month in drawdown. That right here. Some people have the patience to hold a month in drawdown. And some traders, we don't have that patience for price to hopefully come back. If price came back to their position while they held, they would have never been brought back to break even buying up here. And guess what? Guess what? They never will. Welcome to the consequences of buying into a dying company. They never will. I'm sorry, guys. Look at this is a stock. This is a stock, guys. From 2013, this has been falling. From 2013, almost the last 10 years, it's been falling. But when people don't understand why they shouldn't buy in certain areas, it's because they have no knowledge of how to read. So what if I told you that there's a way to figure out how to sell here, how to short here, how to stay out of the market here? What if I told you there was a way to do that? There is, because buying here within, what is this? What was the spike here from 2020? Maybe this was one of the stocks that the Feds use to inject money in. They don't tell you which asset it is, but maybe this was it here. I don't know. Who knows? But from 2020, this pushed up insanely. In 2020, everybody's like, oh yeah, that's on my cards. I gotta get it because, and everybody's chasing this, and they're like, yeah, we're good. No, we're not. No, yeah, we're good. No, we're not. And then they come up. Yep, we're all of this area to cover because no, we're not. And this push down happened in a market that was pushing up. Sorry, I'm sorry for all the drawings, but this push down here happened in a market that was going up. Each and every time we got a push in the market, where did this stock go? June and July, we were pushing heavy in the market. Pushing heavy in the market. The market has rebounded to some levels that were back here. Where is this at? Where will this go? But everybody heard about it right here. And they trusted what they heard in the news and trusted the fundamentals because the company has this and that. Guys, these news companies, they're going to say that. Because guess what? When you start buying, somebody got to buy what they're selling. Buy the asset that's going to be quickly devalued. And then when you have a fall that's 87% after you bought in at your position, you're hoping that you get back there. Hoping. Just like you were hoping that we got back here and hoping that we got here. But where did your hope start? Here. And given that there's not another stimulus to the market, if there is another stimulus to the market, if this ends up being a stock that the feds choose to put the money into to pump the health of the market, if this ends up being that, possibly you might see a rally. But that has to be some unknown event that's going to come and take place. But our habits of reading this and seeing this always aligns with things that are not truthful about this. They're not truthful. You buy in up here, and this is falling down here. And when they get here, they go, Bed Bath & Beyond is they're restructuring their leadership, and they're bringing on more projects, and then they're going to get into the NFT space, and then you're going to be able to virtualize your bathroom mirrors to be able to sell the crypto the minute you open your eyes and wink, and then Dogecoin to the moon. And everybody's loading up again. Oh, let's give it another shot. It's going to go up to yeet, back down again. And you can literally read this on the chart each and every time. You can read this on the chart. So what I'm going to start with is an example of how the market moves, what you want to see when the market moves. I'm going to start with that, and then I'm going to move on to all the other components with how the market moves. Okay, let me choose a better stock to do this with. Let me do this with Elon stock. Guys, this stock is going to hell. Please don't buy the stock. Please don't buy this stock. Don't buy this stock. Please don't. They're gonna exit on all of y'all's heads. Please don't do it. Look at the growth. Look at the structure. Look at the structure. Sorry. Look at the structure of this company. Look at the growth. Insane growth. Exponential growth. We've seen that before. Where did it come back to? This is Bitcoin, by the way, guys. Sorry. We've seen that before. Everybody thought we could not get back down here. This is the last thing that mitigated the structure it came out of. And I'm going to speak on mitigations later. That's just, letting people know. Anybody who's like an Elon fanboy and all that other stuff, we've seen this already. And you can say, oh, that's crypto because the thought. No, it's market structure. And it's the way structure runs in stocks that are obviously overly elevated and have nothing going for themselves, but on insane levels, they're overweight. And then you see huge crashes that come with that. And all the time, that huge spike happens before that push back down. So this is Bitcoin. It's the same thing for Mr. Elon's stock. It's the same thing. Unstable market structure. And there's some hope here, but nope. Bill Gates is currently shorting the stock for right reasons. That's Tesla's target. Everything else is trivial. And the reason why I say that, for the Tesla fanboys and all the people that think electric vehicles are the future, which they are, those companies are not. They're not. Could you imagine if Nokia was just doing that only at the time? And where's the popularity in using those items now? But we still use cell phones, right? So that conversation is one for another day. But yeah, as I said, that's where we're headed. This is where the structure of the market is. That's the same reason why we went down there for Bitcoin too. This is where the structure of the market is. Not up here. And the fact that we're even digging back into structure. No, I'm not even gonna do this. I mean, so yeah, sorry. So what I mean by structure, is the market moves like this, contrary to what people believe. Depending on the time frames that you're on, it all looks different, but it's fractal. It's fractal, and what do I mean by that? So the larger structure of the market, it's the hourly, the yearly, the daily, the weekly, the yearly, the monthly, that as well. That shows you the structure of the overall market, the strength of not just the market. I'm talking about the company that you're looking at, the stock, the instrument, whatever it is you're trading. Those bars, you have these candlesticks here. Let me actually just use my other one. Let's see. No, that's yeah, let me just go through this real quick. Hold on, guys. All right, here we are. So for those who don't know what these candlesticks are, and I'm saying this because I shared this in a lot of spaces, you know, on Facebook and Twitter and all those other places, just zero to hero and charting, all the other mechanics behind this, you have to find out for the industry or the type of market you're trading in. So, but the candlesticks that show the market, they still, you know, designed the same exact way, which is that you have, hold on guys, hold on. The sorry guys, the way these work, the red candles obviously is for, and if it's not obvious, I'm sorry about that. You know, the red candles are going down. That's the value of what this company is going down for the day, for this day, for March 18th. On March 19th, if you waited to buy on March 19th, then your increase would have gone up for the day. So when you're buying and this begins to happen, this is why your position is going down. You see the red candlestick heading down, your position is going down. That's how you read that. And this is for people who don't know candlesticks, you know, so bear with me, you guys who know a little more. When you buy here, depending on where you buy, It took a whole day. It took a whole day to come up this fast or this high. It took a whole day. So if you bought here and you sold here, then you bought when the price was $24 and you sold when the price was $21. And this candle going up is representative of the value of this particular company going up. So the price per share goes up. And there could be many reasons why price goes up and price goes down. But to learn how to trade this, you don't need to know those reasons at all. You don't need to know those reasons, because you can just look at this whole picture alone and know how to make a decision of where you're buying and where you're selling. Or if you guys are trading futures or Forex or any of that, you know where you're shorting, where you're longing. You understand? So that's the basics of what a candlestick is. And the reason why I said red and green is because if you look at these candlesticks, each of them look different. Each of them, they look different. Each of them look different. You see this one here? Does this look like this red one up above here? No. Does this look like the red one here? No. Each of them looks different. And there's so many names that people have for them, but don't get caught up in the name. The type of candle here, let's say you just choose a random candle, maybe not that one, let's choose this one. This doesn't tell you that you should buy or that you should sell. This doesn't tell you that because you saw this as green or you saw this as red. That doesn't tell you buy me now, long me now. That's longing is what buying is. If nobody knows what that is because you don't trade futures or Forex, or if people who do buy and sell stock, they know what that is. I'm not shading you guys, but longing, that's what it's called. You take a position up to buy because you believe price is going up, right? Believe price is going up. These candlesticks are bothering my spirit, so let me just sync them in color. Yeah, so the candlestick being green doesn't mean you should buy. The candlestick being red doesn't mean you should buy. Guess what that means? Guess what that means? That just means that it's going up or down. That's all that means. That's all it means. So I want you guys to condition in your head that seeing this red candle does not mean that you should jump in a sell because you think price is going down. It's where this is located that tells you where to sell, or where it is located that tells you where to buy. It tells you where to buy. You guys understand what I'm saying? So with the no gap candles, I have this indicator on over here. It's called no gap candles. On a stock, this is what it looks like if you're looking at the daily time frame. But the no gap candles fills in the gaps that were created for you to show you, essentially where the market closed and where the market opened up. And then, hold on. And then it shows you that the market closed here and opened up here. You see that gap? So I know a lot of people like to pay attention to these gaps, and for people who trade, they want to trade to have price come down, and like if they see the red candles heading down to here, they try to get in a sell going down to here. But if the position is to fill the gap, usually it's to fill the gap, this little space between the candles on a stock, and sometimes it happens on Forex as well and other commodities as well. But you mainly see it on the stocks. So this gap here, people are of the belief that price is going to come down and fill this gap on the inside right here. They believe that price is going to come and fill that. And they'll get into a position believing that price is going to close the rest of this gap that's here. And what does the market do? Go the other way. So when people are playing this, they're playing the down move to this, to chase there. But they don't understand that going there only means that you're pushing out of the area in stronger force, because there's a gap. A gap is what? I'll explain that later. But this is why I have no gap candles on stocks. If anybody didn't know, it's because of that. Sometimes the market opens, it closes one way and then opens up at another price. And obviously that's how the indexes and stuff like that that these stocks are on. That's also dependent on how they do it. So if you ever heard of NASDAQ, Dow Jones, and S&P 500, that's the index that carries most of the stocks that we buy into. So if you're buying into what is it, Best Buy? What is it, BBY? Yeah. If you're buying into Best Buy is on the New York Stock Exchange, and whatever company Best Buy is located on, I believe it's Best Buy is what, Tech, NASDAQ. However, the NASDAQ as a whole is doing, Best Buy most times will reflect that index. Most times, unless there's something going on with the company itself, it will reflect what that index is doing. Index will be pushing or heading down. There are times where the index is moving up and a certain company is moving down. That could be for many different reasons. But that's just when you buy Best Buy, you buy a share in Best Buy, the share is coming from the New York Stock Exchange as who functions as the exchange for shares, people selling them, people buying through it. It functions as that. But this particular company is located in a particular sector, which is the technology sector. And NASDAQ holds the tech stocks. There are some tech stocks that are on other exchanges, because we have NASDAQ, we have Dow Jones, and we have S&P 500. So it's on either one of those when you're buying from the New York Stock Exchange. So there's people who will trade the health of the whole exchange itself, and then there's people who will trade the health of the stock. And it just depends on, whichever one, you feel comfortable trading and reading. I mean, obviously with the indexes, when you're trading futures, you could make way more money in futures than buying a position somewhere and holding it for price to get there. But I want people to understand that regardless of whether you're on this daily time frame, this is how the daily time frame looks. Whether you're on this time frame, if I was to take, let's say I took this right here, these candles. If I was to take one, let me show you guys. 1, 2, 3, 4, and put a square around it. That's just showing the area that I'm comparing for you guys. So on the daily, it looks like this, these 4 candles, right? Just pay attention to the 4 candles in here. On the 4 hour, and the reason why I have daily, 4 hour, 1 hour, 15, 5, and 1 is because that's the major time frames that people look at in order to determine whether they should hold their position or cut it, whether they should take a position or not. So if someone wants more bang for their buck and just want to trade setting a position and holding it to make some money over the course of a couple days, then they would trade from this 4 hour. That's what they would do. So if you look in here, remember the daily candles right here, 1, 2, 3, 4, 4 days worth of candles. You could break up that data into 4 hours. So now each candle is 4 hours worth of whatever it was that was happening within that time frame. So from 13:30, from 1:30 p.m. to, well, this is market, from this market open. So I'll do this from 9:30 p.m. Does this large red candle to this green candle. From 9:30, 4 hours later, to 1:30, the market was falling, was going down. And when 1:30 came, it started to go up a little bit. But what did I say about this? Just because you see this doesn't mean you should get in. Green doesn't mean buy. Green means the value is going up. It does not mean buy. I want you guys to get a sense of that. It does not mean buy. So, and maintain that going through. Green doesn't mean buy. Red doesn't mean sell. And I mean that because a lot of our psychologies, our impulses to just like quickly buy something and get in is because we see all of this green. And then we follow by a whole bunch of red. And it's because we're basing our positions that we're taking off of whether it's green or whether it's red. That's our psychology behind it. So I want to kill that at the root and get in you guys' heads that because it's red does not mean you should sell. That's how, yes, exactly. Somebody made a point here. Somebody said these colors work for our red light and green lights. When we drive, that's an impulse to drive, y'all, versus stop. Impulse to go versus stop. And if you can trade and make money while it's going down and while it's going up, then now you have an impulse to go down because you see it going down, or you have an impulse for it to go up because you see it going up. But as I mentioned, just because it's red, or just because it's green, or just because whatever your colors are, that means nothing at all. That means nothing. What means something is where that red and green is happening. That's what you should be paying attention to. Where that red and green is happening. Where it's happening. Not what's happening. Not what's happening. We get so lost in, it's green, I need to get in and buy somewhere. It's red, I need to get in and buy somewhere. But it's where. Condition your mind to always say, where am I? Condition yourself to say, where am I? And that will kill that impulse that we have to like jump out there on green or jump out there on red. If you trade in a market where you can make money while it's going down, then now you have twice the impulse. That's why a lot of people stay away from futures and they go into options, because those impulses will kill you in the markets that go up and down. You can make a lot of money and be margin called, because an option can flip. An option can flip. Oh yeah, sorry. Yeah, an option can flip. So it can be worth nothing now, and then by the end of the week, news can hit on it and it's worth a bunch. So people will buy that stuff and not really know how to read what's happening. They won't know how to read what's happening. It's going down. I think we're going to continue falling because this large red candle, the market's not coming back up. Because that's what all of this is made for us to think. Sorry, that looks really ugly. That's what all of this there is made for us to think after we see it. After we see it. So now we're thinking, oh my gosh, it's going to go down here to the lows. And in your mind, because you see red happening and you see this large candle heading down, the next day the market opens up. Because they like to buy at the end of the day. Oh, we're going to do a swing play. Yeah, this is definitely going to go down. The next day the market opens up. And they were looking for a McFlurry to fall, and they got a McShaft right back into drawdown. And now their position that they're in, they're losing money. So this is the 1 hour. That 4 hours of data that I told you guys about before. There was 4 days, I believe it was. This one candle, 1, 2, 3, 4, that's November 1st, November 2nd, November 3rd, and November 4th. That's these 4 candles on a lower time frame, on a 4 hour. There's more candles within it because there's that one daily candle. Now that one candle is broken up into 4 hour candles. It's still a day worth of data, But this is just how it went per every 4 hours, essentially. That this current market was, in place. So with this is the company, Best Buy. So with this company, you have to wait until the stock exchange opens to trade it, and when it closes, you can't, unless you have larger positions in shares and you're like, doing things after hours. That's a little more advanced. That's larger money that's doing that. Nobody in this chat got money to be doing that. So this is 4 hours of data. That same said 4 hours of data can be broken down into 1 hour. Now, each candle within those 4 days, you can tell what was happening hour by hour. Hour by hour. Sorry, let me stop drawing on this because I know y'all get confused when I'm drawing. Let me just use this. We make these arrows bigger. Make a particular color. There we go. This red candle right here. That red candle right here, where the white circle is around. That's 1430. That's 2:30. At 2:30, the value of that company kept going down the whole hour. And when 3:30 came, the value was still going down. So if you were in a position where you were shorting, you'd make money as long as this is going down. But what happens when the market closes? This kept falling from 3:30 Eastern Standard Time to 4:30 Eastern Standard Time. And the market closed with it down. So there's a lot of people that like to get in positions here when the market is closing and hope that we open up and go down here. They hope that we open up and continue down. So at the end of the day, they get in right here. What's this number that they're getting in at? Here. They get in at 68.50. And the market opens up at 69.14 and goes as high as 69.98. So the position that they bought in at 68.50 to go down, it's going against them, against what they thought was happening. Why? Because red was sell and green was buy. We said location matters, right? So going through this 1 hour, we can now go down to the 15-minute, the 5-minute, and the 1 minute to see the same amount of data that happened over 4 days. You can see the same amount. And now it's just broken down into smaller parts. And this is the time frame that traders trade on, or at least should, because when the stock is down here at 9:30 during the day, and they see that the market reverses, and now the market is beginning to go up, they know at 10:12 where they could get in, and they might continue to take it up until 12:56 Eastern Standard Time. Let's say 1300. So from 10 o'clock to 1300, they were able to understand what was happening from the 1 minute time frame, and they were able to get in a position here and take that position up to wherever the market will deliver it. So there are ways to understand when a market is going to reverse and go back up, and when a market that has been going up is going to reverse and go back down. There are specific patterns that the market shows when it's ready to change its direction. The fastest that you see it happen is the 1 minute. So when traders use the 1 minute, they may hold a position from 11:35 and be out of that position by 11:46. Just for a little bit, whatever their position was, they put a certain amount of money in it, in that one position they were taking, and in 13 minutes, they took it from here to here, held, and then took their profit and got out. That's what trading is, versus having to wait a couple of days for the market to get to wherever it is you believe it was going, its final stop, before it reverses. So the reversals, when the market is reversing, the reversals happen on every time frame. They just look different on each of them, but they are all happening the same way. So let me go into how the market moves, how it's constructed. Let me actually just go here. I like this better. I can go back to my so okay, so here's how the market moves. The market has a starting point, and the starting point currently in the market of whatever it is we buy and whatever it is we sell is whatever time we come into the market and see what's happening. But the structure of the market is created like this. There's a low here. There's a high put in. That's the market going up. But what you guys see is the one candlestick followed by the next one candlestick, followed by the next one candlestick, followed by the next one candlestick, and maybe followed by like a little down candlestick here, and then followed again by another one candlestick going up, and then another candlestick going up. That's what you're seeing as the data being printed. You see it going up, but what's happening is that it's actually doing this. It's actually doing this. It's going up. It's going down. When it goes back down, and it doesn't go all the way to the beginning of where it came, that's a retracement down. And oftentimes when price in a market that goes, let me actually pause it right here. In a market that goes up, there is also a pullback in a healthy market. It's healthy for the market to go up, the price to go up, and then the price to go down by a little. That's very healthy. It's a healthy movement in a market. That's what it does. So there's down below here, there's a bunch of people that are buying from here. And with them buying from there, the more people that are buying, the price is continuing to push up. Because there's more people wanting that. There's more people, there's more demand for it. So the value of it, it's supply and demand, the value of it goes up. But when people no longer want it, because the price is a little bit too high, or when people felt like, okay, I got in right here and I made money, I'm going to get out right here. You have a ton of people getting out here and they're taking whatever profit they had from buying here, right? And then you have a group of buyers here, up here, at the top. There's a group, sorry, let me actually just put this in. There's a group of people buying here for price to go up. And that's how these guys are able to take, sorry, that arrow is horrible. That's how, let me actually just use it. This here, that red going down, red. That's because they're taking their money out of the market. They have to sell it. They're selling. And there are people here that are buying, waiting for it to go up. Waiting for it to go further, or hoping that it goes further. This is where the news mentioned it. Oh yeah, we heard that they were structural contracting of the, that's where the news starts mentioning it. Why? Because these guys are ready to sell, but they need buyers to sell it to. Who are they selling it to? Who are they selling it to? People who are eager to get in because they heard and they saw and they believed that it was going to continue going up. And as they're selling off here, there's a ton of people buying in at all of these different levels. They're buying. They're buying. As this is all going down, ton of people buying. That's the way these guys get to sell out. They're selling to the people buying at all these different levels. All these different levels. So when the market pushes up, they have a buyer at the top, they have a buyer here, they have a buyer here, a buyer here, buyer, and all of these people are losing money on the value of their position because they're buying in hopes that it continues up. They're buying in hope that it continues up. So let me just delete this again. So when they're buying here and price is going down, they start to see their account going into the negative. By whatever position, you know, whatever amount of money they put, by the amount of shares that they bought and what the decrease in value is per share, it's going down. So the reason why I marked out this point here is because when the market goes up, let me actually move. So when the market goes up from here, let's say it was just coming down. I'm going to draw a downtrend. So this is the market rocking its way down, as I mentioned in the beginning, remember? So then the market gets to a particular place in the market based on like the previous history that we see, the previous data. What's the previous data, one might ask? The previous data is just what you see now. All of this. You see this? These candlesticks? My candlesticks are white and black, but most people's candlesticks is red and green. So this is the previous data that you're looking at. And when the market opens up, there are areas that the market will move to, to what? There's a term called mitigate. The term is to collect orders above, right? How does the market get there? That's what someone may ask. It gets there based on whatever it tapped into in previous data back here. And if that area is sufficient enough to expect the market to begin going up. So as you don't hear me say anything about, do you see the down candle and the power bottom, apple top of the world's cherry? You know, like we're not, it's that it's going up and it's going down. So only consider that. Only keep that in your mind. It's going up or it's going down. And my only business with it going up and down is where I should take my position and what kind of position it is that I'm taking. Is it a position that is to long? I believe price is going up. Is it a position to short? I believe price is going down. Or is it a position to buy because I believe price is going up? Or is it a position to sell out of my stocks because I believe price is going down? That data is reflected on this move up. It's reflected on candlesticks with this move up. So this back here is old data in the market that we just talked about down here. Sorry. Where am I? Oh, yeah. This data that I talked about here, and what's here is the previous data that's currently available right now. When the market opens, new data is printed, or if the market continues, more data is continuing to be printed. That's crypto. Crypto's still moving right now, cryptocurrencies. So you can trade that, you can buy it and hold the position and hold it for a couple of days and get some value on it, or short it for a couple of days and get some value on it too. You can do that from the higher time frames, and that's 24/7, no breaks at all. The stock market is with, if you're doing it on, with the companies, with the shares, then it's when the stock market opens and closes, and it's whatever stock market there is. There's a ton of stock markets around the world, so it's whatever that is. And if you're on futures, then it's 23/5 actually. So there's 1 hour where you can't trade, the spread hour, and then 23 hours in a day, the market is still moving with these series of moves going up and moves going down. And you could make money. You can make money 23 hours a day if you're just right about the positions that you're taking and where the market will go next. So this is the market going up from an origin. This is the beginning of it. It's going up from here. So as I mentioned, a healthy retracement for the market is at least by 30 to 50%. And oftentimes you may even see it come down to, about 80, 90% of the last move that pushed up. I'm not talking about candlesticks, a particular candle. I'm talking about the move that you see based on the time frame that you're trading from. So a strong market will come from about 50% of this leg up. And what will it do? It will continue. It will continue up. I know it's so ugly, but it would continue up like that. That's how a strong market would look, right? Oh, that's right. You see this? This is what I trade. This is a strong market, right? What I said was that you have the rocking downtrend, right? And then you have this move that goes up. From an origin, some previous data that's in the back. That previous data here is this area, this wick. Remember earlier I mentioned the candlesticks? This one candlestick has a body on it, and sometimes there's a wick on one side and a wick on the other. Sometimes there's only a wick on one side. Sometimes there's no wick at all. This one white candle pushing up right here, y'all see that? There's no wick on it at all. Zero wick. present on this one candle. Sorry, there's one candle. So some candles have wicks, some candles don't. So in a previous area in price, there are areas where the market stops, turns around, like I showed you guys in the illustration above. Wherever it is. Oh, this is on. Wait, what is that? Oh, right here, sorry. Yeah. So right here. Sorry about that, guys. Hope I'm not boring you. So let's say the market taps into that area we just discussed down there. We said tapping into that area could cause price to reverse and now start going up. So where do you want to buy? You want to buy low. Where do you want to sell? You want to sell high. So that means that when price is pushing up, most people want to take the profit that they have as their position is increasing, close their order, and they've made money. But then some people close their order and want to get in again. So getting in again, let me actually, right here. So getting in again to go up would require you to know where the market is going to stop and turn around. So along this entire push up right here, along this entire push up right here, let me just shade that. Along this entire push up, while the market was pushing up, there were certain areas that were left behind on this whole move here, on this whole push up, because the market doesn't look like that when it's moving up. What does it look like? It looks like this. So since this is the 1 hour, if you go down to the 15-minute, maybe not the 15-minute, if you go down to the 1 minute, you begin to see this. Let me change this color real quick. This is how you teach free of charge. And use your time freely. On the 15th, let me actually zoom into this. Sorry. So this huge move up is that for a couple of hours, price was moving. It kept going. For a couple of hours, it kept going up. Guys, on YouTube, there is a huge delay with this. I do have some music playing on, actually, let me bring the music down for the Zoom people. I do have some music playing on Zoom. I just turned it down some, but there's about 69 people on it. So if you join the Zoom chat, a lot of your questions will be seen faster, as well as you'll be hearing this a lot faster, not 30 seconds delayed. So, sorry, with this right here, This move up. If you go down to the 1 hour, this is the 1 hour. If you go down to the 1 minute, or let's say the 5 minute, you're going to see that this move up, this straight move up, or, you know, it could be, you know, a couple of candles, like 2, 3 candles. It could be a candle here. Let me actually, followed by a candle here that went down. Followed by a candle here that went up. Another candle here that went up. Another candle here that went up. Followed by a candle that went down like that. And then there just happened to be, like, let's say, a huge push up, and you see it go like that. So this is how the market looks when it's moving up. And on the 1 hour, you'll see the candles looking like this on the 1 hour. You'll see the candles. Sorry, hold on. You see the candles look like this on the 1 hour. I don't know why I just didn't do that. It'll look like this. And this is how the market moved up. So it was going up, it had a pullback down, it's going up again, it had a pullback down, and it was going up again. So that's how it looks. That's how it looks, just like that, on the hourly time frame. And on the hourly time frame, the highs and lows would be larger, like this. I'm gonna fix that. Depending on what you're trading. Sorry, depending on what you're trading, it would look like that. But during that time that it's going up, it's pulling back. This is maybe an hour, 2, 3 hours that it's been falling. And then you could have a couple hours that it's going up. For you, where you want to get in is you want to get in at an area where price is going to continue, or where price is going to begin to go down if you're trading something that you can short. Short is to make money on the downside. The price is going down. You believe, or you're placing a position or a bet on the price going down, and it begins to go down. That's shorting it. You're shorting it. There's some people that are shorting while price is going up, and that's how they're losing as price is going up. They're saying, we're placing a bet essentially that it's going to be going down based on what I looked at this chart, based on what I looked at the chart and the chart said. So I'm going to enter a short position. And that, in an uptrend, in a market that's going up, you could enter a short position anywhere where you see the market retracing, and you can enter a long position anywhere you see the market is going up from. Now, on the 1 hour, it looks like this. But let's say the 5 minute, the 1 minute, let's say that the 5 minute and the 1 minute begins to look like this. So now it looks like this. And now you see that on the 5 minute and the 1 minute, let me put it here. Now you see on the 5 minute and the 1 minute, I'll move this. The 5 minute and the 1 minute, price looks different. Let me extend this out a little bit just for you guys. Yeah, on the 5 minute and the 1 minute, price looks different. Price looks like this. For you artists, I know this is ugly. Please just bear with me. Jesus, God. Hold on. Sorry, guys. So here's a better picture of it. Do you women do things better than men, right? Here's a better picture of it. This is how it looks. So let's say this one black line going up is the 1 hour. You have the 1 minute, which is this green trend, and it's a series of highs and lows, highs, lows, highs, lows, high, low, high, low, high, low, high, low, high, low. But on let's say the 15 minute, on the 15 minute, it's 1 low, 1 high, 1 low, 1 high, 1 low, 1 high. And the hourly, it's just 1 low and 1 high. So you see all of these different pullbacks on the 1 minute, followed by these slower pullbacks, 0, 1, 2, 3, 4. You see that this is actually pointing to the fact that on the 1 minute, there's more pullbacks to time and hope to be right. There's more opportunities where you hope to be right, or more opportunities where you can be wrong, versus there are less opportunities on the 15 minute, and they're slower opportunities. They're not happening as fast to be right. But if you're trying to make money for the day, you have about 3 to 4 opportunities on the 1 minute within that short amount of time that you're trading, 1-2 hours, to be right or wrong. To be right or wrong. To be right about a pullback or wrong about a pullback. To be right about a reversal or wrong about a reversal. But it's literally like this. The market's moving like this. And if you look here, remember I said that the market pulls back? So let's say this is the hourly pullback. The hourly pullback. Here's the hourly beginning. Wait, what is that? No. Here's the hourly beginning. Here's the hourly top of the market and reversal. And the hourly reversal led us here. It stopped here before continuing up above like that. Stop there. Yeah, stop there and continue up above. So when the hourly time frame is pulling back, what do you have? Just like on this move up, where on the 1 or 5 minute, you have these series of highs and lows coming up. With these highs and lows, you could place a buy here. I don't know what this was. You can place a buy here. Oh, it's because it's zoomed out. You can place a buy here when price comes back to the area that you're looking to buy from. And you can take profit or take your money out of the market as it increases when price goes above the high, above the high that it's going above to the left. There's this low, there's this high, there's this low, and then we break above the high that brought us down here. Now, this is only happening on the 1 minute or the 5 minute. On the hourly, it looks like a candle that's going oftentimes up and down. You see it going up and down. So if the candle opens, and let's say it opens right here. Let's say this is a candle opening and it starts to go up. If the candle opens and it begins to go up, the candle opens and it begins to go up, it looks like this. It looks like this. But if the candle begins to go back down, because on the 1 minute time frame, remember what we said, we can go up and back down a number of times, a series of times. We can go up and down a series of times. So while that 1 minute candle has been formed, the 1 hour candle, while the 1 hour candle's formed, we have price going like this. That whole hour. And sometimes the hour can close here. The hour candle can close right there. And the candle looks like that. Sometimes it can close there and the candle looks like that. Sometimes it can close down here and the candle looks like that. So, yeah, candle looks like that. It could look just like that. They call that a doji. It's actually an institutional candle. It looks like that. So when this happens, it's because on a lower time frame, let me just delete some of this so it doesn't look. When this happens like this, it's because when the candle opened up, let's say this was the candle. Let me move some of this out of the way right now. When the candle opened up, we were here. And the price went down. And then during the hour, we started to go back up again on the lower time frame. We started to go back up. And as we were going back up, a couple minutes later, we started going down again. And we did that during that hour. And the candle closed like this. The candle closed just like this. Because the first half of the hour, we were going down. The second half of the hour, we began to go up. And then by the time the next hour candle was opening up, price was back here. And all of this happened within 1 hour. All of this entire thing, This moved down, this moved back up, this moved down, happened in 1 hour. So what were there? An opportunity to go short, an opportunity to go long, an opportunity to go short again, and an opportunity to go long again. That's only if you're trading on the lower time frames. You find multiple opportunities during the day to be able to take a position to buy or to sell. So let me bring this back. So we begin to head up. And this is how we're looking for the hourly. We're going up like this on the 1 minute, the 5 minute, the 15 minute, 10 minute, whatever it is. That's a series of ups and downs, highs and lows. That's what they call it. Highs and lows. That's what it's called. So this is the low of the hourly trend. This is the high of the hourly trend. And this is where the hourly trend pulled back. Then the hourly trend continued up. What's the trend? I forgot to say that. I'm sorry, guys. The trend is if the market is going up, there's a bunch of highs and lows that are created as it's going up. That's trending up. If the market is going down, that's a series of highs and lows that are trending down. Trending down. So with the market going up, you're in an uptrend. And with the market going down, you're in a downtrend. A downtrend. I'm saying that for people who just may not really understand that. The downtrend looks exactly like the uptrend, where we are going down, we make a high, and then we make another low. We make a high, and then we make another low. We make a high, and then we make another low. Like that. This is what the 1 minute, the 5 minute is doing. As you see the 1 hour, just launching back like Godzilla before you. And you would just be praying that you didn't buy right here to go up. Because now you're going down and your position is going down in value. And a lot of people, because they got in here, they hold the position hoping that it's going to get back here again. They hold that here, hoping that it comes back here again as it's going down. And it's decreasing and becoming worthless with every push down. Ooh, ooh, every push down. It's becoming worthless and worthless and worthless and worthless. And then they close in a loss. Because they don't understand that now that the market is going down, if you are trading, you should be short. You should be short until the market gets back to what? The hourly place that it's looking to continue up. Like that. Let me just make that. like that. Continue up. So the higher time frame is this. The green, maybe I should make it yellow because it might look a little better. Yellow is the hourly trend. And the hourly trend has been going up for hours, sometimes days, sometimes weeks. Is going up, depending on what time frame you're looking at. So if you're trading from the hourly, you have to wait until maybe Tuesday to get in a position that might bring you to your profit on Thursday, Friday, maybe. But if you're trading on the 1 minute, the 15 minute, you may be getting in at a position, at maybe like, I don't know, 10:30. And you may hold that position until 12 o'clock and be like, you know what, I'm out. So as the hourly trend was going up, you took a position and got out of the move in profit along this 1 hour hourly trend up. And you were guided by where you saw the hourly move turning around. So when the market is going up, it's because there's a demand for that particular thing, that stock, that market as a whole. There's a demand for it. So on the charts, you can see where the demand is at. You can see where the demand is located. And oftentimes, the demand is located at a particular point that the market reversed. And the same way we have the demand that sends price higher. We have the demand that sends price higher down here, right? We have a supply above right here that's designed, and it's not there, it's actually back here. We have a supply area that's above right here. Some previous area, as price was going down, that price, sorry, actually I should actually just stick with and mitigate it, So right here, you have a supply area above. Down here, somewhere below, you have a demand area. That demand area, the demand from below, that demand area below is where price originally came from. So 2 weeks ago, the market was down here at these levels, and the market began to go up, and it kept pushing up. And when price came back, let me actually just do this. When price came back to the area that it was 2 weeks ago, there was still this area that it was at 2 weeks ago. There was still people willing to buy at this price. There was a ton of people waiting because what? They missed this whole move right here going up. I'm going to highlight it red. They missed that whole move right here going up. This whole move going up. And price came back to the area where it sent that whole move up. But on the way back down, it's downtrending, right? It's downtrending. Low, high, low, high, low, high. So as it's going down, you can get into a position, a short position, to say based on what I've analyzed, or based on where we previously pulled back from, because remember, we said that there are pullbacks, right? And then continuations. The market continues going up after it pulls back. It continues going up after it pulls back. That's in a healthy market. Or it continues going down. Right here, let me highlight this a different color. It continues going down. Oh, no, not green. Yeah. It continues going down. So what you see here, this yellow movement down, this yellow line, this is the movement down. So if you know where the market is going to begin to go down, you can enter a short position to make money while it's going down. And every area where you believe it's retracing up and tapping into to continue down, you can add another position going down. So now you're making 2 times the money that you would have been making if you took 2 positions up here. You began to make 2 times when this position was opened, and you continued down. That's given that the market will continue down. How do we know the market is not going to continue down? Well, the area that it came from is the deciding factor. So this whole push up right here came from here. This is where the market came back to, right here. And it pushed up again from here. So here is where you want to be buying to go up. And here is where you want to take your profit, or you want to begin shorting to go down. but you will only know those areas to short from and hold as the market begins its down cycle. You see this 1 minute red, the red lines. That's the market going down, and that's multiple positions on the 1 minute to be able to find an entry and go down. The problem is within these multiple entries to go up and down, within these multiple entries to go up and down, you have this low, this high, this low, this high, this low, this high. You have 6 opportunities to find an area that you can get in to go short, or find an area that you can get in to go long. And it doesn't mean that on the 1 minute you're getting, or the 5 minute, you're getting in a position right here. That doesn't mean you're getting in a position. Sorry, let me. To hold. Let's say you got in there. That doesn't mean that you're getting in a position to hold, to continue all the way up here. You want it to go all the way up here. Because that's not the way the market moves. There's only one place actually most people are trying to buy here, right here, in this green area. And they're buying to go up, but this area is not the area designed to send the market very high, like push the market high. You can't expect to hold so much profit all the way until we get all the way up here, because the market is trending down. So if you chose to take this position to buy, just know that it's going to a position to sell or to short. So you're buying to go to the area that you're looking to short from in a downtrend. If you want to get involved here, then you can, but you have to know you're getting involved here on the 1 minute to go up here. And because the market is going down, you're going to get more from finding a position to go down than you will for finding a position to go up, because the overall market is currently going down. But that doesn't mean that there's not quick opportunities that you can go up with, because as the market, as there are a series of highs and lows, you can time where to buy those lows from and where to sell or short those highs from. Where to buy or long a low In a falling market, where to buy or long a low as a market is going down, because the markets go up and they go down every single day. You can get involved in a trade going up or a trade going down to make money, but you need to know where you're going to get involved in that trade going up and for how long, and where you're going to get involved in that trade going down for how long too. Because just because it's been going down for most of the day doesn't mean that somewhere during the day it can have a huge push up and start to now trend up. And as it's trending up, all you're looking for as it's trending up, guys, pay attention to this and nothing else when it comes to structure. All you're looking for is for areas in which you can get in for a short or get in for a long. Get in for a buy or get in for a sell. And depending on the time frame that you're on, you have multiple opportunities to buy and you have multiple opportunities to sell. So the higher the time frame you are on, the less opportunities there are to find a position to buy in, or to find a position to sell in, or to find a position to short in, or to find a position to long in, or find a position to enter in, or find a position to exit in. Whatever it is that your mind makes up as to why you're getting in and where you're getting out, it's either to buy or to sell, to short or to long, to get in as an entry and to take profit. Right? I hope this is making sense for somebody. So we remember where all of these longs, where all of these longs and these shorts are. They're highs and lows, and they're areas where you could get in for a short, get in to sell, or get in to buy and go up. That's all I want you to think about. I don't want you to think about anything else. No power bottom, hammer, bar, nothing, just that movement alone. This is what we're teaching, the structure of the market. So the structure of the market moves this way. Series of highs and lows going down on a lower time frame. On a higher time frame, it can just look like it's just going down. So on a higher time frame, there's that opportunity as it's going down. There's that opportunity to go down for a longer period of time and stop, then turn around and go up for a longer period of time. But within the smaller time frames, it's going up, then it's going down, then 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 it's going down, then it's going up, and it's going down, then it's going up, then it's going down. And that's all of this that I just explained right here. So if you draw it on your chart, when we're going up in a higher time frame trend, there will be multiple highs and lows, highs and lows, highs and lows. If you're looking at the lower time frame, if you're looking at the higher time frame, all you'll see is price going up and then price going down. And it will take this move up. It could be a couple of hours that it's doing that. And now as it's going down for a couple of hours too. It's just within those hours that it's going up. There's multiple people buying and selling, 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 buying and selling. But there's more buying going on than there is selling or taking profit. And as it's going down, there's more buying and selling, 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 buying and selling. There's more of that, but what? There's more sells. There's more people selling or shorting the position than there are people longing. So the people who are longing have limited opportunities to buy, get in, and get out. 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 They have multiple opportunities, but they are limited. Why are they limited? They're limited because according to the parent time frame, according to the parent structure, according to the structure that has the authority more than the lower time frame structure, according to the higher time frame structure, we are going up. So more money follows that until what? Until what? Until we hit what's called our supply. So when the market started to go up, I told you that it was going up from a place of demand. I told you where the demand was. The demand is located at the beginning of this whole trend that we moved up with. It's at the beginning of it, the beginning of it. Listen to that. I'm going to get into the other stuff with supply and demand, because there's multiple demands and multiple supplies when you are on different time frames. In the current market, you might see one supply area above and one demand area below on a higher time frame. But on a lower time frame, you see a bunch of supply areas above and a bunch of demand areas below. What are those supply and demand areas on the lower time frame? What are they? Those supply and demand areas are the lows and the highs. But when we're going up, the supply is a previous high. The supply is a previous high in the market. You see up here, previous high in the market. This red, let me actually just change this color right here, so it's not confusing. This is a previous high in the market that the price or the candlesticks that are going up, they will tap into, it'll touch, and then what? It's gonna begin going down. It's gonna begin going down. After it touches that area. it begins to go down. So when it touches that area in the current trend going up, we just make this another color. In the current trend going up to take us there, this current trend that's heading up to take us there, you'll see let me actually just draw it better. I could actually just use arrows. I don't know why I don't do this. In the current trend that's heading up, we're going to a supply, a previous area or a previous high point in that former trend that price was coming down in. We will go back to those highs, and at those highs there are different things that take place. You'll have price go down after touching there, and it will go down into some area below, which is the demand, the previous demand. There's a series of, remember what I said, there's a series of highs and lows in here on this hourly trend, the yellow line on this hourly trend. There's a series of highs and lows in here. And with a series of highs and lows in here, there are lows on the lower time frame, little pullbacks on the lower time frame, little retracements on the lower time frame that price will touch and continue up again if it's going to continue up. So you have the supply, which is a previous high that price goes to, an old high that it goes to, and it reacts from, and it begins to go down. That old high is the area that you want to begin to look to sell the market, to short. That's what you want to look at. That old high that's up there. You want to look at that. And when the market gets there and it touches and pulls away, when it touches there and it pulls away, you can get into a short position, make money, and that short position oftentimes is heading to a demand so it can tap there, and people who are buying, they will buy from the demand and price will continue. Now, it doesn't always continue higher than the area that it began falling from, the area that it tapped into the supply. The supply, when price tapped into a supply, it made a high on that supply, and then it lowered price. So that's a previous high that's there. That's a previous high. Now, some people might say, but you said the previous high is a supply. Yes, I did. The previous high is a supply. Absolutely correct. But in a trend moving up, price can tap into the previous supply and give you a little movement away from it, but then it can continue. So you got into a sell position here. You got into a sell position here to try and sell the market down or short the market, and it went down just a little bit. There's a little profit, but then it came back to the area that you were willing to close if you started losing too much, which is called your stop loss, or where your stop loss should be. So you're looking to get in right here and sell the market down, and you're willing to get out here if you were wrong about the position. If you were wrong about the position. So this supply helps you to determine, if your trade goes in the opposite direction and you are losing money, the end of this supply, the top of this old high, it's where you're getting out. It's where your stop loss is. It's where you say, I was wrong. You guys hear me? I was wrong. I was wrong about price going down. And this is where I'm willing to maintain my stance on price going down until I reverse my bias, until I shift it, until I change it. I was wrong about that area. Now, just because you change your bias and price put you in drawdown and you lost your money, that doesn't mean that you automatically jump into another trade and try to go up with it. That doesn't mean that. Because if you jump into a trade and you try to go up with it, and price was only going a little bit up above the previous high into the supply again. Remember the supply that was back here that sent price down? And there was a supply that was created here. But this is not the supply you're looking to sell from. This is a supply that will give you a reaction, yes. But it's not something you're looking to sell and hold until you go all the way down here. Unless something happens here in this particular area, to let you know that price is going down. Now, that's a type of pattern or movement that the candlesticks will show you. Likewise, when you get here into the demand, there's a pattern that the candlesticks form most times that will let you know that we're turning around from here and we're going back up. Where? Up to where we came from, or sorry, this won't let me be great. Come on, move out of here. Or we're going to where we came from, or we're going beyond that. But that decision doesn't happen here in the middle of the market. That happens at the low, which is at a former low, or that happens at the high, which is at a former high, a former supply, or a former demand. So the best places for you to get involved in a trade when you're going to buy or when you're going to sell, it is, say it with me, only at an area of supply, or an area of demand. Nowhere else. I don't care If you saw this going up, oh my gosh, it's going. If that's happening on the time frame that you choose to place a trade on, you miss that move. That's not for you to get in. You are trying to get in. And when you miss this move and it was leaving, that's not where you're trying to get in. You are trying to get in. Sorry. This dot is going to bother me, so let me move it. You're trying to get in at whatever supply that price taps into, or whatever demand that price taps into. Where it came from, this move up came from somewhere. Where did it come from? It came from this area down below. And more importantly, write this down. Write this down, because this is where it changes. This is for people who do not understand charting at all. This is where it changes. Write this down. It came from here. Yes, this is where the market pivoted and turned and went up, right? We see that. We clearly see that. If you guys think I'm yelling at you, I'm not yelling at you. It's my passion, so leave me alone. So let me actually bring this down so it's not in the way of the meeting controls. There we go. Yeah, I hope this doesn't. No, this is probably gonna bother somebody. Oh, I can just do this. Right here. Yeah, I just wanted to get to this button back here. So in this whole move up, that's going up, this white line right here, this whole move that's going up, you're not looking to get in there. You're not looking to buy there. You're looking to buy when the market comes back to where it came from, or you're looking to sell the market from where it previously came from, some area where it's going to on the higher time frame. But oftentimes, that area that you're looking to sell from, if you want more in your sell, if you want more money when you're selling, when you're shorting, if you want more value when you're selling, when you're shorting, you would be shorting from some hourly area that's back here. The hourly area back here, where price came from the hourly. This is where price came from. If you want to hold on to a long move, just like if you want to hold on to a long move and price is coming from a particular area, you want to hold on to a long buy if it's from a demand that's on a higher time frame. And you want to hold on to a long sell or a long short if price is being rejected right here from a higher time frame area. That's where you're looking to sell and hold. This is where you're looking. The demand is where you're looking to buy and hold, right? Sell and hold. Buy and hold, right? So the supply is always above a former high, a previous high, and the demand is always below a previous low, a former low. And you're only looking to buy and sell from those areas. But somebody would ask the question, what if we have, I'm going to make this, what if we have a bunch of lows? What if we have let me just make this, bring it to the front. What if we have a bunch of former lows? Let me bring this to the front too. So I wish they had a button you could press to just bring certain things to the front with just a button, not even. All right. So somebody would ask, or somebody would say that on the 1 minute, there's a bunch of lows. Let me do this again. On the 1 minute, or on the 5 minute, or whatever it is, there's a bunch of lows. So when prices, when price on the 1 hour is now heading down from the supply that it tapped into above. When price is now heading down on the 1 minute, on the 5 minute, on the 15 minute, you see all of these down moves. All of these down moves. Make this white. You see all of these down moves. Down, 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 down. You see all of these previous down moves as price is heading down, like this. As price is heading down, you see all of these down moves, all of these demands. These are little demand zones, many demand zones. You see all of these. Demand here, demand here, demand here, demand here, demand here. Those are, all of those areas are demand zones on the lower time frame. All of them are demand zones. Every single low here is a demand zone on a lower time frame. So as price is going down, this is why you have price going down in a series. Sorry, let me just delete this real quick. Oh no, actually I didn't have to delete that. I just gotta make the line bigger. You can tell this was impromptu. I'm not even ready for it. So on these highs and lows that the market is making, you see this red line that's going down, where I said you could buy from the low to go up, or you could sell from the high to go down in a downtrend, right? In a downtrend. Get that in your head. You're buying temporarily in a downtrend in specific areas that you can get a little bit of something and get out. If you're scalping, if you're scalping and you're like, what if price is coming down and it just goes straight through this? Can price do that? Yes. The answer is yes. Yes. It can. Yes. These lows on the 1 minute, even though there's times where you could buy from it, are there times where price can go straight through it? Yes. Price can. Why? Because the overall trend that price is currently in from the higher time frame is short. And it is short to get down to a particular area on the hourly before it begins to go long again. Before it begins to go long again. So you're having these series of highs and lows that are coming down, but it's only coming to a particular area on the higher time frame to then reverse. So on the lower time frame, if you're somebody who's trading and you want a bunch of opportunities to be able to get in and out of trades, I'm in for a little bit, out for a little bit, in for a little bit, out for a little bit, in for, you know, like well, not in for a little bit, out for a little bit, but in for a little bit, in for a little bit, take my profit and I'm out. In for a little bit, take my profit, I'm out. In for a little bit, take my profit, I'm out. On the 1 minute, on the 5 minute, on the 15 minute, throughout the entire trading day while the market is open, it's going to be making highs and lows and highs and lows and highs and lows and highs and lows. Whether it's going up or whether it's going down, it's going to be making highs and lows and highs and lows and highs and lows. So you're not chasing price going up and you're not chasing price going down. You're not saying, oh, I see this. This is where it tapped into right here. This is where it tapped. You're not saying it tapped the former low here. It ran below this low. It ran below that and came all the way to this former low right here. Maybe I should just bring it here. Let's say it just ran below. That looks so ugly, but I can't fix it. Well, that's the best that I could do. So it ran through this low right here. It ran through this demand zone. Remember, the demand zone, the demand zones on the 1 minute and on the 5 minute are not as strong as the demand zones that are on the higher time frame, that are on the 1 hour, that are on the 15 hour, the 15 minute, that are on that. It's weaker. It won't hold here. Price won't tap here and go to the heavens above, because on the hourly, the area that the hourly is looking to get to is not here, but it's here, because there's some move down here that is trying to come and tap into and then continue up above. So on the higher time frame, if you're trading minute by minute, you have to be aware of where you are in the market. Are you at that hourly area where price is looking to reverse from? Are you there? If you are, then it's best for you to understand that though you are looking for longs here, you have to see a particular pattern happen with the candlesticks. I'm going to teach that in a few. A particular pattern that happens with the candlesticks, you have to see that happen before you begin looking for buys. before you begin looking for buys, there's a particular pattern with the candlesticks that you want to see. So when price gets to that 1 hour area, there's a particular pattern within here that you want to see happen before you begin to look to get into buys that you believe. This is the point, that you believe, not that you believe, sorry, that the area that you're trading from, is set to begin to turn price around and take it higher on the higher time frame. Now, when price gets here, you're looking to buy a move, and this is the move that you could look to start buying to hold for a longer period of time. Down here, this is the move that you're looking for. Now, some people might ask, if you're on the 1 minute, how do you know whether this is going to hold, whether this is going to be the move that it goes from, or whether this is going to be the move that it comes from? That's where your multi-time frame analysis comes from. So we found what the trend was on the 1 hour. And the 1 hour trend, we saw that it was reversing because it tapped into a demand zone. So it was reversing. And as it was reversing from this hourly area, on the lower time frames, we began to see a series of highs and lows as price continues to go up to the area on the higher time frame that it's looking to reverse from. It's looking to reverse from that area on the higher time frame and go back to another area on the lower time frame. On the higher time, another area on the higher time frame that it's also going to reverse from again and continue up. So your job as a trader and as reading these charts is to look for those areas that price is going to continue to go up from, or price is going to continue to go down from. And depending on what time frame you are trading on, you can hold that move for a couple of minutes or a couple of points, or you could hold that move for a lot of points. It depends on what time frame you're trading on. So on the hourly, in that hourly area, when price goes to tap that, and we look for price to turn around from that area, you can hold that area for a lot of points, coming from there to go back to the supply. You could hold that trade from the demand for a lot of points from the hourly, if it taps into an hourly demand zone and reverses to continue. And on the lower time frame, when it gets to that hourly place on the lower time frame, there's a candlestick pattern or a candlestick movement that you want to see that should confirm to you. It should confirm to you that now you're going to begin to look for buys going up. So if I'm going to be on the lower time frame, there's going to be multiple opportunities for those buys to get back to that hourly supply area. When I'm getting in on this hourly demand, there's going to be multiple opportunities as it's going up on the lower time frame to get me to that supply, that hourly supply. From what? The hourly demand, the hourly supply. And let me actually just make an hourly demand. So this is the hourly demand. This area here, there's an hourly demand that's here. And some people might be asking, well, how do we know where the hourly demand is? And other people may ask, if you said that it's the beginning of the move that price is coming back to, somebody else might ask, if you said it's the beginning of the move that price is coming back to, why is it that within the middle, price tapped there in the middle and then continued to go higher? You might ask that. That's the way that the market moves. That's the way that the market moves. The cheeseburger in the 60s, 50s, whenever it was 25 cents. Right here, 25 cents. It went all the way up to, let's say, I don't know, 40, 50, no, maybe something incremental. It went all the way up to 60 cents. Because Bill Gates was buying up all the cows and then he just raised the prices, you know, whatever it is you want to believe. Because I'm sure whatever it is that man buys in large droves, he has to report on his financial thing. So if you want to know who's buying up what, just know that those people with a lot of money, they have to report their earnings and their financial moves. So look into that before you believe what anybody says. But so we have price coming back down. It went from 65 cents above up here to back to 25 cents. And then the supply chain issue happened. Oh my gosh, raised it back up. Raised it back up to 50 cents. 50 cents. It brought it back to 50 cents. And then brought price back down, not to 25 cents. Not to 25 cents. It brought price down to, let's say, 39 cents. But it was 25 cents and everybody we loved it. Oh my gosh, the health that it brought us, the strength of vigor, said no one ever. The cheeseburger definitely was in demand. Wow, like hotcakes is going. So the price went up. But when the price pulled back down, the people who missed this opportunity here have an opportunity to get in again before it begins to head up. Before it begins to head up. If it's something that's going to be a part of our future, if it's something that's going to have value within the future, and that value is not determined by if they say that they're going to create a robot that's going to cook everything you ever want, and you never have to go food shopping again. Because the robot is just going to be able to generate all of it out of thin air, and when it comes time, in case of emergencies, it can deliver your baby too. It can deliver your baby too. But it doesn't stop there. It doesn't stop there. And all of these things are being said, and the price is going higher. Jeez. Goodness. I remember when it was 25 cents. And when it was 25 cents, then and China got involved. And then they did something. Thank God the government did something for it. But then those communist bastards, they just got involved again. And none of those prices are related to anything that the government is doing. So I don't know why we even talking about that. It goes up again. It goes up again. If anybody's new to this channel and this is the first video you're watching, welcome. It goes up again. It goes back to the former area that it was in. It was highly valued in. Goes to that area, and what? Prices begin to fall again. Because at this area, there's more supply. There's more supply here than there is the current demand that's going up. The demand for it started to weaken the demand for it every time we were going up on the hourly, the demand for it would get stronger and stronger and stronger. And every time price pull back just a little bit, just a small, let me actually just save this as a template and then make the rest of them. Yeah. The demand for it, every time it pulled back. Didn't I just say that? No, I didn't. I thought I said this. Look at first trying to play me. Price, look at trade and be done. Oh, now it want to go there? Okay. So look, here we go. Wow, so we just still gonna give me issues, huh? Okay. I apologize, guys, with my technical difficulties. All right. Yes, here we go. So as we continue, I apologize for that. As we continue, the demand for it, people are still buying. You see how we're going up and coming down, going up, coming down, going up, coming, you're coming back down, going back up. People are still buying as these prices head down. And right here, the prices are still going up. Still going up. Like this. Sorry, actually. What is, oh, never mind. So the prices are still going up here like this. You see it's still going up. The green boxes, this is the demand. The demand is still sending price higher. People are still involved. People are still buying. That's why it keeps going up. It keeps going up. Sometimes it comes back and touches the previous area right here. And sometimes it doesn't right here. Sometimes it doesn't even come back and touch the demand down here because it's so strong. So much buying is going on, pushing price higher. I started with this saying that what happens if we continue to push and the market doesn't pull back? It's an unstable market. The reason why we pull back is because we're creating a structure in the market, and that structure is creating stability for the market. Now, the market is not perfect, so within the market, a lot of the times you have price push, and don't pull back. Guess what? That just means that it's prime for a huge pullback into a previous demand. But what has to happen first? What has to happen first? What if the supply was here? Because there are certain days where news takes place. And it pushes the market up. What if we come above this supply right here? We come up above this supply right here. Whatever it is here, we come up above it, we break through it, we break through that supply. And then you see us start to pull back. You see us start to pull back into the demand. And the next supply is all the way up here. Can the market go here? Will the market go here? There's a possibility that it can. Yes, there's a possibility that price can just stop here and start to go all the way down here. If the market is going all the way down here, and now it's going below the previous area it came from, that's telling you on a higher time frame that now the market is in a higher time frame bearish trend. But currently, this higher time frame is a bullish one. Healthy pullback, continuation above. How do we know when the market is in the higher time frame is in a downtrend? When the higher time frame is in a downtrend, that higher time frame, the structure, the candlesticks that are going down will end up going below. You see this area right here? This area, let me circle it. What let's see what color. Maybe something bright. Yeah, I guess. So here, this is where the market went down on the hourly and it pivoted up, right? So if the market comes back to this area, oftentimes it'll come back to this area, give a healthy pullback, and then you'll see it continue above. Then you'll see it continue above like that. Give a healthy pullback and continue. That's if it's going to continue its uptrend. But if the market is breaking down, not a lot of people are buying, whatever it is that's happening. When the market runs its former low, the former low that it put in, when it put in the high, the former low, the former demand, when the market ruins or takes out or runs or goes below the former area that it came from, that's the first sign that the market is reversing and it's going to start to go down. It's going to start to go in a downtrend. And now you might be able to find areas where you could expect price to come and tap back into, and then find a longer move down from the hourly time frame. But when does that happen? That happens after the low that it came from. That happens after it is violated. After we run below it, it pulls back up into the area and then provides us with a short going down. So this yellow line is the hourly. The white line could be your 1 minute, 5 minute, 15 minute, whatever it is. It's lower than the higher trend that you're following. And on that lower time frame, you have multiple opportunities to buy, as well as you have multiple opportunities to sell, multiple opportunities to do it. But what? They have to be in areas that you could expect price to reverse from and continue. You could expect price to reverse from and continue. These areas are areas of supply and areas of demand. Areas of supply and areas of demand. So just because a demand is created down here on the hourly doesn't mean that price is going to, it has to come down here. No, it does not have to come down here. Price can go here. Price can stop right here and continue higher like that because of, well, that's usually after a high is put in and this is ran. We took the high, we ran above the former high, so we're not looking for any sells or any rejections. We came above the former high. And if you're trending up and you tapped into a demand zone below, we're expecting the demand zone below, the last area below the price came from, we're expecting that from here to put in a new high above where the previous high came from. Or where the low came from. So this low here came from this high here. So as we begin to make our way back up, we're looking for price to come up to this high that we just came from. Why? Because that's supply and demand. If there's more demand, we take it to the supply and take price as high as we can. And when there's no demand there. And there's more supply present. The value of the current thing that you're trading at that supply, and there's no demand left. There's no strong demand anymore. At that supply, you will see price start to break down, start to shift lower, to go back to an area of demand, a low, a former low, or a former area that price came out of, to tap into. And if there's enough demand there, guess what that demand does? If there's enough demand there, that demand, sorry, let me move this. That demand puts in a new high. If there's enough demand here, and you still have people waiting to get back to here, but there was enough demand here. And somebody might be like, how do you know that there's enough demand there? Because when you get there on the lower time frame, you have a series of highs and lows coming down. Sorry, this is so ugly. Let me draw something else. You have a series of highs and lows. I don't know. I don't know what's going on with my drawing skills. I don't know. Is this is the angle of this? Look at me. Like, what is happening? It's not me. It's you trading me. I mean, it's me because I drew it. But look, we have a series of lows, highs, lows, highs, lows. Don't worry, I'm gonna fix it. Highs, lows, highs, lows. We have a series of that. We have a series of that. Coming down. Series of lows and highs coming down, right? Down. But then, so let me make this red. Have a series of lows and highs coming down. And what happens? Let me just change the color of this. What happens? When we get to that 1 hour demand zone, remember we said this is the demand. Let's say this is the demand, the green box. When we get to that 1 hour demand zone that's down here, I apologize, guys. My OCD is the reason why I'm so accurate, so you have to accept it. So we get here to the demand zone. And we're expecting price to go higher, right? What are we looking to happen in this demand zone if we're expecting price to go higher? We're looking for price to go above an old high, because as we're going down, we're making low, high, low, high, low, high, low. And then we put in a high right here. Price moves really fast. Put in a high that violates the former high. Remember what we said, if we know we were going up in this market, and if we wanted to know whether we were going to go down, we would have to violate an old low, right? So on the lower time frames, when you're reversing from a higher time frame demand, you have the run of a former high that's there. When that former high is ran, price retraces and what? You guessed it, correct. Continues in its uptrend. Maybe I need to do this on an angle or something. I'm like, what? This is so ugly. I don't know. I'm better at fixing it than I am at creating it. So now you see a demand just like this. Now you see a demand just like that, right? And sorry, not demand. Now you see a reversal. Now you see a reversal, and the trend is moving up, and you see demands are being created. You're seeing that demands are being created again. Supplies are being created again. But these supplies that are being created are tapping into former supplies to the left. Tapping into former supplies to the left, former highs, former areas of supply. Because the truth is, you guys keep hearing me say supplies at the highs and lows, but the supplies at the highs and lows are the ones that I'm telling you guys to choose, because that's where the larger movement comes from within the smaller trends. But there are times where price will not go back to that demand below. It will just go right here and start to continue higher, just like this. It'll go right there and start to continue higher. So it'll go to the top of the old high right here. The old high, it'll go to the top of the old high and continue up like that. Just like that. So you guys hear me saying that at the bottom of the 1 minute trend, there are demands there. But there are multiple demands within the 1 minute trend. Because even on the 1 minute trend, even on the 5 minute trend, even on the 15-minute trend, even on the 15-minute trend, there's also a series of highs and lows in here too. There's also a series of highs and lows in there too. And that series of highs and lows, that is provided by the candlesticks that you see. The candlesticks that you see are forming those small highs and lows inside of it. So just like on the 15-minute, where you could expect little areas of supply for the market to tap into and give you a rejection back down before continuing higher, the same way that you have that on the 15-minute is the same way that you have smaller ones in there on the 1 minute. So now the smaller ones, these smaller ones on the 1 minute, the smaller down moves, the down candles, the down areas before price continues higher, these can give you buys and sells too. These can give you buys and sells too. Based on the smaller areas of demand. But just know that those smaller areas of demand and the smaller areas of supply above on the 1 minute, they don't hold as much as the higher time frame ones do. But you can find entries here. You just have to understand that those entries are only for a couple of points or a quick move. So it's a larger position, but a quicker move. You're in and out, in and out. That's scalping. That's what I teach. That's what I do on on YouTube every day live. I show you areas that you're able to get in and get out of the market using this entire way that I just explained to you guys that the market is structured. Using multiple supply areas, multiple demand areas, and I'm pointing that out with what? With just these squares. With just these squares. That's what I'm pointing that out with. These squares. And then you see the movement happen, you see the flip, and now you know you're looking to get involved in buys. But the buys, you're only looking to get involved in buys when the market flips at previous demands. Not in the middle, not after price tapped it and it's running up to take out the high. Not at that time. You're looking to get in here when the market pulls back and you want your entry to take you higher. Because oftentimes, if the market is not looking to go up from here, you will have your entry here. Sorry, you will have your entry here. You will have your stop loss here. Your stop loss is how much you're willing to lose based on the size of your account, how much you're willing to lose. For anybody that doesn't know, how much you're willing to lose before you get out of the trade and stop your loss from going further, eating into the rest of your account that you currently have. So it's how much you're willing to risk right here. Your entry is here in the middle of this area. Your stop is behind the area that you're trading from, behind the zone that you're trading from. It's behind the zone. And you're looking to target potentially the new high. But as price is going up, remember what I said. There's a series of highs and lows in here that takes you up. So guess what? With the series of highs and lows that take you up, if price is not going to run this high, what it's going to look like is you have these highs and lows going up, right? Price stops right here at some former supply area that's there. And what does it do? It violates one of the older lows. If it violates one of the older lows on the 1 minute, you know, the 1 minute cycle now is getting ready to go into a downtrend. But for how long? Most times, it can just be going back to a previous area where it started, and it's going to continue higher. How do you know it's going to continue higher? Because it's going to run one of its older highs, taps in and continues like that. And this is how the market pivots. This is how the market moves. And this that I just mentioned, the way this market chooses to pivot, this that I just mentioned is the market's cycle of how it goes up, when it reverses, now how it's going down, and when it reverses, to how it's going up. And all I'm doing on the 1 minute when I'm trading during the live sessions is just tracing all of those areas that price is bouncing off of to continue. So your entry is the bounce to continue, or the bounce to short, the bounce to go down or the bounce to go up, the bounce for the retracement or the bounce for price to continue going up. That's all it is. And guess what? Guess what? How do we know? How do we know where the areas are that price is going to retrace from or start to go down from before it continues up? Oftentimes it's right near the former highs. So when it gets to its former high, you see it retrace down. And then when it gets to the former area below, or the demand, one of the demands that's within the smaller trend, what does it do? It continues up. So if you want to get involved in the market, you can get involved in the market on a quick scalp going down, which is risky because it's against the trend. You saw the trend just changed right here once we ran that former high. So you can get involved with a scalp going down that's quick, but it has to be at an area of supply. When it's going up, you can get involved in any side of the market, any side of the market. That's a sell or a buy, but you must know where you are. You must know where you are. What is the current trend? Market structure, that's what it is. What is market structure? The highs and lows that we're currently seeing. How do we know that the market is still going up? Was any lows violated? Here's a low. Here's a low. Here's a low. No lows are violated yet. So what are we expecting? We're expecting price to turn back and retrace and continue, right? And then what does that create? The next low. The next low that's there. That's what it creates, the next low. And when price is ready to go down again, what are you looking for? What's going to happen? What are you looking to see? You see a low violated, right? Where does that low tap into though? To go back up and then short. The low taps into a previous demand after violating the old demand. There's a demand just below it at times that it taps into to go back up. And now you're looking for shorts to go down. as the market is going back down. All you're looking for is opportunities to short now. Until you see one of your highs violated. And now you're going long again. Until what? Until what? It's deja vu, y'all. It's deja vu. Until we see a low violated. And then now we're going down again. To where we could stop here. There could be some imbalance. Now on the playlist, I have a master's class playlist. I want you guys to watch it after watching this video. This will be the first video on the master's class playlist because everybody will have access to this information. Thanks to Armani, by the way. But this will be the first video. The other videos in the playlist teaches you more in depth about these POIs and which one or point of interest, that's what it's called, about these zones, about these demands, about these supplies. It teaches you which ones you could use to make more profit from versus which ones you should just not use and wait and let it get to the other one. It teaches you that in the master's class playlist, but you first must understand how the market moves. And this is the structure in which the market moves. And these different lines denote the time frames that you're seeing all of these highs and lows in, and all of these highs and lows within these time frames are areas where you can get involved in the right direction. In the right direction. One of the biggest issues that we have is being on the wrong side of the market. Why? Because we don't know where our former highs are, and we don't know where our former lows are. And a violation of it is what gives us the next trend in that direction. What gives us the higher time frame retracement. Y'all know the higher time frame? Y'all talking about, you know, like you want to take moves on a higher time frame? The lower time frame will tell you when the higher time frame is pulling back. How? Because we are violating one of these lows. We tap back in and then we short. And now we're beginning the downtrend, and you have multiple opportunities to find shorts. Why? Here's a banger that a lot of people don't know. Y'all ready? Y'all ready? Here's a banger that a lot of people don't know. Now, some people do. Some people do on in my group because I teach it, but here's a banger that a lot of people don't know. The market, if you're counting the pullbacks, these little pullbacks that the market keeps going back and tapping into something, if you count the pullbacks, oftentimes when the market is pulling back, you get 4 to 6 pullbacks. And oftentimes the 7th one fails. The 7th one, oftentimes the 7th one fails. Sometimes I see the market, it's 3 of them and 4 of them happen, and then it's done. It reverses. How do you know when the reversal is happening? We just taught that, when the violation happens. So even if you're counting these, you're counting these along with looking for these. And when you're counting these, it's letting you know, guess what's coming, bad boy? Guess what's about to show up? Y'all been waiting? Y'all ready? And usually the 4th to 6th one is forming around what? Ooh, goodness. Goodness. The 4 to 6 is forming around the area that it's getting ready to reject from and begin what?
Ooh, baby.
And begin the 4 to 6 combo slice again. And they be running retail crazy in the market because retail is what? What are we doing? We trying to sell down here. Sell down here and the market goes up. Sell down here and the market goes up. Sell down here and the market goes up. And then we try to buy up here and the market goes down. Buy up here and the market goes down. Buy up here and the market goes down. What are we doing? When according to market structure, there's a way in which the market moves. And we're trading what we think and what we see. Sorry, we're trading what we think and what we believe we see, but it's not what's actually happening in the market. It's not what's actually happening in the market. That's what I want people to understand. It's not what is actually happening in the market. So there's types of candlestick patterns that people are at times waiting for to happen. There's types of candlestick patterns that people are waiting to happen. They're waiting for it to happen. And while they're waiting for it to happen, they don't know where they are. Where are you? Are you in a zone? If you're in a zone, then yes. If you're not in a zone, then no. So if you see price pushing like this, how dare you put in a long? How reckless are you to put in a long going when we understand that the market pulls back and continues, pulls back and continues, pulls back and continues, pulls back and continues, pulls back and continues. We understand that. So our profitability is in the pullback. Our life getting better is in the pullback. Our hope is in the pullback. Our dreams, our visions, all the things that we want is when life pulls us back. When it pulls us down and we don't understand why. We had a place of too much supply. We had a place of too much going on. We had a place that was overvalued in our lives. And the blessing was in the undervalued spot. The undervalued spot. That's where it was. That's where the profitability was. So we waited for that. We waited for that. So I know that this is a lot to digest. There's a lot to digest. A lot was taught here, a lot, but this is the structure of the market. So if you ever want to know what market structure is, and you want to get out of this retail support and resistance, which retail support and resistance is waiting for price to go below the demand, violate the demand, but they're trying to chase or put in sells once we get the run of the demand, once we go below the demand. They're trying to put in sells right here because they say that we're in a range, and the range consists of all of the orders that's happening within here. And they tell you that you should look for a sell to go below here or a buy to go above here when the market reverses. When the market goes below here, it reverses and comes back into the range. When the market goes above here, it reverses and comes back into the range. So you're not looking for an entry above or below the last supply above or the last demand below. You're not looking to chase the run or the breakout of it, or you're not looking to just jump in because it's heavy selling pressure after the run of a low. No. Because after the run of a low, what do we get? What did we just explain? What did we just explain here? After the run of a low, we explained that after the run of a low, there is what? A pullback. So why on earth would we be chasing a sell below a demand if after it went below the demand, it pulled back? So I know that that's a lot to take in, and that's where I'm going to pause for today. And tomorrow I'm going to take you guys to church and help you guys to understand market structure and where to get in and where to get out. Precisely, exactly. But you first need to understand this. You first need to grasp this. You first need to know this. You first need to know, get it out your head. The market does not run on support and resistance. I get that that's the thing we've been taught for the longest of whatever. And no, wrong. It does not run on support and resistance. And if you wanted to classify what support and resistance was, there are zones that you can call support and resistance. Zones that you can call support and resistance. And you can take that as an entry from the support, or that as an entry from the resistance, not from these areas that are above or below a particular range. Because that's how you get wrapped up quick. And I'm going to teach that tomorrow. So I'm going to teach that maybe in the evening. Should be like more like 4 or 5. No, not 4 or 5. Maybe like 7 o'clock Eastern Standard Time, because at least I can give you guys some examples in a real market, right? Because that's what mentors do. That's what real teachers do. In the real market, they will teach you as it's happening because they know what they know as the teacher, as the mentor. So this is an entirely spontaneous course that I just went through. That was amazing though. I'm glad I got that explanation. I'm glad I got that in, because wow, that's gonna help a lot of people with structure and not chasing these dumb areas where it's like, oh my gosh, we just went above a certain area, let's get in now. And that's the way the market is designed. Go above a certain area, come back into it. Go above a certain area, come back into it. Go above a certain area, come back into it. So why are you chasing the area to go up if it's always coming back in? Wouldn't you find it coming back in, or find it coming out of it? Hey, yo. So yeah, I'm in there. I'm in there. There's a lot of heat in one day. I know other people who dang, I didn't even record this. I'm so upset. It's just on YouTube, so now it's gonna have to stay on YouTube. For a lot of people who don't understand structure, who don't understand market structure, like this should help. But what I want you guys to understand, and this is why I'm coming back to teach this tomorrow, One, because I love talking and I love teaching, but two, because there are times when the market comes below this right here, and when it goes back up, it puts in another high. So I know we talked about the demands being violated, but there are times where when the demand is violated, it will put in another high. And it's how to avoid that. So don't think that just because you saw that and you got that and it's like, oh yeah, that's great, it's gonna. No, this is the bridge. I've used other people as the bridge in times, and that was my fault for bridging their garbage work with this hot sauce that the Lord Jesus Christ gave me. That was a mistake. And this here is what real market structure is. This is market structure with supply and demand on multiple time frames. I gave you no candlesticks. I showed you nothing at all other than lines. And with these lines, this is exactly how the market moves. And when I come back tomorrow, I'm going to show you guys exactly how it works together with the candlesticks, with them. And we're going to work through it together, because then this series of structure and supply and demand will go into structure the right way, and then swing points, and then all of the other stuff, the candlestick structure, the little tiny candlesticks, and how you can time the very beginning of the move and take it from the bottom to the top of where the rest of the market will go. I'm going to explain that for you guys. So I know I did plan to answer a bunch of questions. I didn't really get around to it. I do apologize. You guys know I love talking and I talk so much, but I hope this was heat for you guys. I hope this was a great explanation for you guys. And tomorrow we're gonna come back for more. Tomorrow it is gonna be fire. Y'all want to be there. I don't know if I'm gonna have it on YouTube now, because tomorrow is essentially still going over all the stuff that I went over in the rest of the playlist. This is just a bridge to what supply and demand is and what support and resistance is. And then I'm going to give the rest of the video on how to identify supply and demand. This is not what support and resistance is. Sorry, this is what support and resistance is not. That's what I was showing you guys. But what supply and demand is and what market structure is, this is what I just went over with no candlesticks. Tomorrow I will do it with candlesticks, so you see how this all aligns together, and then where it's best for you to get into a trade, what time frames it's best to look at, how to correlate one time frame, a higher time frame with a lower time frame, so you're able to get that move on the lower time frame and risk a little less than you have to be able to get the larger time frame move. Because if you're risking from the large time frame, then you're also risking a lot more. And what I mean by that is that if you look here, let me show you guys this. And I'm doing this because I know other people are going to come back and watch this. If you get into a buy right here, an hourly buy, look at where your stop loss is. Look at where your risk is. You're risking all of this just to hope that you make this up above, up here, just to hope that it comes all the way up here to run the high. You're risking all of this. But what if I told you you'd be able to risk this much? You'll see that little sliver of red, this much, in order to get the same amount. That's where multi-time frame analysis comes in. And that's where identifying those areas within multi-time frame analysis that's going to get you that small stop loss, that small risk. I tell people all the time, I want to pay peanuts to eat caviar. I don't want to pay caviar money to eat caviar. Please, I could split that money 20 ways from Sunday. Go into more things that matter. None caviar. You got caviar for you off $25 off. You can you learn to preserve capital that way. But that's what I want. I don't want to work hard. Who wants to work hard? What? Hardest worker in the room? I was that for years. Where did that get me? Nowhere? Nah. So I'm going to be back tomorrow, 7 o'clock, 7 p.m. Eastern Standard Time. That's 7 p.m. Eastern Standard Time. So that's 1900 Eastern Standard Time. 1900 Eastern Standard Time. I'm going to do the second part of this video, and it's going to run right into, no, not work hard until you get smarter. Absolutely not. Get smarter so you don't have to work hard. Sorry, somebody put that in the Zoom thing. Get smarter so you don't have to work hard. My dad always used to tell me when I was younger, son, I want you to go to school and get an education so you don't have to work as hard as I do. And little did he know, he meant get an education, but it wasn't in school for me. And I have a college degree. It wasn't in school for me. Get education, yes. But it's subjective to where that is. And the education for you to prosper in the markets is here on this channel and every live stream you show up to. In this Discord, 7 p.m. Eastern Standard Time, EST. Your profitability is on these live streams in the Discord that we currently have. Join a Discord if you guys have not done so already. It's here. The link is on one of these videos, or maybe on this video. I'm not sure, but join the Discord. Be a part of what we do. There's people who come in and get offended because I'm so like militant when it comes to learning, but this is direct. You don't have the opportunity to mess up. This is the 1 minute time frame that I trade from. And when we be finding hourly moves, right? 4-hour moves on the 1 minute. And so militant because that discipline helped me to be as precise as I am today. And I'm precise every day that I come in the market. I dare you or anybody that's new and that's listening to the sound of my voice, come on live stream. I dare you. And try to edit and alter whatever analysis I'm given. I promise you, you will get chopped up. Why? Because my analysis is always correct when I'm live. You guys hear me? You heard that? That sounds pompous and arrogant, right? That sounds like not smart Raja concepts, right? To say something like that, right? That's what that sounds like. But nope. I said that and I mean it. If I tell you there's a cow in your backyard and you go back there and the cow is not there, you better call the police because somebody stole your cow. Someone stole your cow. And if you live in an apartment, someone stole the cow out of your backyard. I promise you. You better call the police. All right, guys. So I hope that was helpful. Get out of here. Thanks everybody for coming out. I hope you guys learned as much as you were able to. I know this is long-winded. It was a very long teaching and longer than I expected, but this is the beginning of it. And this paired with what we're coming back for tomorrow will help you get that right footing in the market. You're going to have days where you still have down days, you still have up days, because the market moves opposite of our impulse. So if our impulse is to buy, oftentimes the market is selling at that time when our impulse is to buy. When our impulse is to sell, oftentimes the market is buying at that time. Market moves opposite of our impulse. Opposite of our impulse. Opposite of our impulse. That's what I said, right? Opposite of our impulse. Opposite of our impulse. And with this, let me actually just note this out. These pullbacks happen at previous highs that were former pullbacks. So the pullbacks happen within the pullbacks. Pullbacks happen within the former pullbacks. The current pullbacks will happen in a former pullback. The current pullback will happen in a former pullback. But the current pullback happens at the former pullback's previous trend. So the bullish the pullback that's on a bullish trend will happen at the area that it pulled back on a bearish trend. But y'all are gonna get that tomorrow. So I'll see you guys soon. I appreciate you guys. And I'll see you guys soon. As we always do in our live streams, you know, turn this music up and we're gonna dance ourselves right on home. And I'll see you guys soon. All right. You guys enjoy. You can spam up the chat with hearts and everything, whatever it is you need to, however it is you need to get out, whatever you need to say, I'll read whatever it is that I'm reading within like the last couple of minutes of listening to this, and I'm out of here. But I'll see you guys soon. Later, guys. Enjoy.